Good morning, and I hope everyone had a great Diwali. Welcome to the 22nd episode of the Capital League Insight series of webinars. The topic for today's discussion is India, Headwinds and Tailwinds. The newspaper headlines in the last few weeks and months have been quite dramatic. There are a number of global developments that have occurred after several decades. One never really thought that countries like the US and the UK would see such high rates of inflation, which have normally been associated with weaker developing economies, or that the highly developed and sophisticated countries in Europe would be concerned about energy supply in the coming winter and request citizens to cut down on consumption, or that various strong global currencies like the British pound and the euro and the Japanese yen would depreciate by 18 to 20% in a matter of few months, or that the leading central banks in the world, like the Fed and the ECB and the Bank of England, would have to resort to unprecedented pace of rate hikes to protect their populations from the vagaries of high inflation. The supply chain disruptions and tightness in labor markets have become more entrenched, leaving little hope for a quick normalization of inflation or reversal of interest rates. And these global conditions have created challenges and headwinds for governments, central banks, and businesses all over the world like never before. So far, India has stood tall in the face of these headwinds. The government has handled the inflation threat with quick policy initiatives, whether by increasing the purchase of crude from Russia, going up from 1% to 20% of our imports, or changing tariffs on petrol, diesel, edible oil, steel, crude exports, wheat exports, etc. And India has been an oasis in an otherwise turbulent world. We have been fairly resilient, be it our economy or interest rates or stock markets. And this has been partly on account of our conservative policy response during COVID, and partly because of the prudent reforms undertaken over the last few years to formalize the economy and focus on making India self-reliant. So today, all balance sheets, be it government, corporate, household, or external, are in far better shape to take on these challenges. But the same global issues are also creating some tailwinds for the Indian economy. However, it would be premature to assume that we can navigate the current crisis, which also has major geopolitical undertones, without any major disruption. Also, in the past, a strong dollar has always led to some global crisis or the other, and it is unlikely that it will be any different this time. So to elaborate on this tug of war between the headwinds and the tailwinds for India, we have with us today Nilesh Surana, Chief Investment Officer at Mirae Asset Mutual Fund. Nilesh is an industry veteran with over 26 years of experience and has been rated as one of the best fund managers in various forums on account of his excellent grasp of macroeconomics and a stellar performance track record. Thank you for joining us today, Nilesh. Welcome.
Yeah, good morning, Rajul. Thanks for inviting me.
No, it's our pleasure. So before we start the discussion, I would like to mention for the benefit of our audience that we shall have a Q&A session towards the end. And I would request you all to type your questions in the Q&A section at the bottom of your screens and address it to the panelists. Nilesh, I would now request you to start by sharing your views.
Yeah, thanks again, Rajul, Sapna, and team at the Capital League. It's always our pleasure to interact with you and your esteemed clients. And it's a mutual learning. You gave a very nice sort of background in terms of what are the points to ponder, what are the macro variables. And when you sort of called me and mentioned the title, I think it's quite apt, Headwinds and Tailwinds.
Absolutely.
So I will try to cover primarily from a lens of equity investing, equity wealth creation over the period of time, because while macro noises on various economic data points are extremely important, but not everything sort of collates into the longer term journey for wealth creation, which is more determinant of underlying resilience of the business to face the headwinds and yet grow earnings. I mean, that's the broad message towards the end. Would like to conclude. So I have a sort of a structured presentation. I would cover some part of, I mean, the important parts of it, and would have a monologue for about 25 minutes, 30 minutes. And as Rajul mentioned, then we can have more interactive session subsequently. So, one second. Sorry,
I can see the screen.
Yeah. Yes. 1 second, please.
Sure.
So I will not touch on each of the data points, and before that, before, I mean, just to what sort of Rajul was sort of mentioning, what the year has been. I think this year has been extremely unique, and is in fact a bit brutal in the sense, like at the start of the year, no one would have thought a war would take place. No one would have thought that you would see a significant sort of erosion across asset classes. Particularly, the most important is the global bond prices. Bond prices, because of the increase in the interest rates, have come down significantly, about 15-20%, which has never happened since 1950s. So, I mean, this is just the score on the sort of card as we speak in terms of what has happened over the last 10 months. And to start with, straight away, I will bifurcate into 3 pieces. First is we'll cover the headwinds. And while Rajul did touch upon it, I think to my mind, from the lens of Indian economy and equity markets, there are 2 important headwinds. One is interest rates, because interest rates, as Warren Buffett said, is like gravity. So, I mean, if it has a large implication across asset classes, including equities. Equities are the longest duration asset class. So any movement, all else being equal, does impact it. So we'll touch on that interest rate part. And second would be the second headwind, which is material, is what's happening on the energy side, because all of us know that India depends 85% of its imports is dependent. Crude is imported. And what is slightly less known, that whether it is fertilizer, coal, gas, all that put together, the basket, we have seen some unusual erratic movement in the current calendar year. I think these 2, to my mind, are the headwinds. Rest, of course, everything is important, but one can talk and debate, but doesn't move the needle as much, whether it is erraticity of monsoon, whether it is what's happening in some pieces in geopolitics, etc. So let me sort of cover first, sort of focus on these 2 sort of headwinds, and we will just go through and stress test some of the trends which are taking place over the medium term in certain sets of businesses, and we'll stress test for these 2 headwinds, which is basically how interest would impact the trend, if any, and what is the impact of energy, and then we'll come to the markets, earnings, etc., and on that. So on the first part, of course, it's a very complex subject. Not many people would have envisaged this a year back. Quantitative tightening also would not have people imagined a year back than what it is. So it's very difficult to sort of accurately forecast, and things can change a lot. But one thing which is a central thing is what's happening to the interest rates. And there are factors, just to very quickly run through, what are the factors which are leading to increase in the interest rates in India. And what, in my opinion, probably that the increase may not be as significant as and not be ad infinitum. So to that extent, I mean, first is obviously all of us know it's driven by global interest rate cycle, is driven essentially by what's happening in US, and the Fed is fighting inflation, and unprecedented inflation. And inflation in US of 8-9% is is the equivalent of 20-25% in India, something like that. If you look at 2016 to 19 and all throughout, they wanted 2% inflation. They were in the range of 1.5, 1.6. They were yearning to have higher inflation. But it has gone all beyond, and there is a bit of urgency or even probably panic, and Fed priorities or the government priorities, particularly central bank priorities, is now absolutely to curtail the inflation. All else has become secondary. So there is a global fight against inflation, particularly in US. But in India, that's not the case. We'll come to that. So this is an important thing, that this flight is in particularly in US. And by the way, inflation, some basics is that obviously that it's a YOY thing. So all else in being equal, particularly inflation, which is caused by commodity prices, sort of peaked out in March, June of this year, when we saw oil moving up and all those commodities. We have a slide where it is corrected by almost 20-30% X of crude. So all else being equal by March, June, the base would be in that. The tricky part in US, whatever limited understanding on the subject I have, is that the economy is solid. And the tricky part of this inflation is the services, and within that, the labor inflation. There is less of supply, more of demand, and that happened post-COVID. And to that extent, that is where it is not so easy, and it would be a lagging indicator. So there'll be a slowdown or recession by invitation by Fed, and only after a period of time we will see unemployment rate they want an unemployment rate to move up. Which has not been happening as we speak. So I think that's a complex piece, but in both the points, inflation, stickiness of labor inflation, I think India is totally different. So it's just that because US is increasing interest rates, globally all countries, to protect their currency, are increasing the interest rate. That is one central theme. If US is 10-year is offering closer to 4% or so, it's very different scenario in terms of, and particularly with the strength of the currency. So most countries, barring China, as and Japan resistance, have rate increase spike. Some of them due to inflation, some of them because what US is doing. The other part is the commodity prices and the current account part, which impacts. So these are the moving factors or the headwinds why interest rates should increase. I think if we take a deep breath and look 1 year down the line, the inflation even in US is about 3.2 Bloomberg consensus for the fourth quarter of calendar year 2023. As I said, it's a YOY number. Second, in India, it is, as I said, it is not that our inflation is skyrocketing. Of course, food is volatile, but even RBI estimate is 5.5 for FY24, which is a couple of quarters down the line. So I think March, June is when it would come comfortably below 6%, which is what longer term is around 5%. So it's not something out of urgent in that context. There is still surplus liquidity, although it has come down. Second is also the fact that these are not tailwinds, but these are why I'm saying that probably the impact would be cushioned, is that if the entire strategy of Fed is and central banks is to slow down, obviously economy will slow down. It will be a soft landing, hard landing, anyone's guess. How painful it would be a slowdown. But if it is a slowdown, that means inflation would decelerate, the manufacturing inflation. So the end game again is that inflation would come down. And lastly, there is a bottom-up trigger, which has not happened but should happen. Is that if India G-Secs are included in global bond indices, with Russia getting out, why it is important? It impacts flow of money and thus financing of the deficit and thus the system-wide liquidity. So all in all, my view is that 10-year is already at around 7.5%. I think while it may spike in the near term or not, it's very difficult to say because it's all global data points. But a year down the line, I would say it's comfortably around this would be the peak or around that. So it's not that it would be higher for longer in India. The joker in the pack is only the oil price if it were to go abrupt, but it's that. So this is one area which is clearly headwind. It impacts cost of capital, it impacts cost of equity, it impacts all asset classes, any asset class, even real estate, everything. The implied, implicit or explicit discounting factor is a function of the risk-free rate. So if the rates move up, the valuation of asset classes, all else being equal, come down. So that's one thing. Second, and which is more unique to India, is the impact of oil prices. And as I said, it's not oil, it's basically energy basket, be it oil, gas, has gone berserk because of the Europe geopolitics, basically Russia-Ukraine crisis. And coal has moved up, and fertilizer is essentially conversion of gas. All that has impacted our current account, our inflation, our obviously the subsidy or the burden which the government has to bear in terms of reducing excise duty, and LPG subsidy is still borne by the government. So to that extent, I think unfortunately in India, if there is one single risk in the longer term, or always has been a couple of decades back and even now, is till the time EVs become big, is sensitivity to the oil prices. And the cushion is slightly increased by about $15-20 because our IT and other exports have moved up. But that said, above 100, it's clearly a bit of delicate zone. It impacts, as I said, multiple sort of things. Just to complete the commodity thing, as I was mentioning that on the inflation, that if you X off Brent, even oil has come down by about 15-20%. Would notice there has been a sharp fall in the global commodity prices. Now, coming to the second part, I would like to revisit certain trends which are shaping up in the Indian economy. Some of it were pre-COVID, but COVID sort of has delayed it, the recovery which could have happened otherwise. Some of it is structured more. I mean, these are all cyclical, let's say from a 3-year perspective, minus 2 year, next 2 years, 4-5 years, that period perspective. What's been happening and why in aggregate we would be able to handle the two headwinds, which is higher interest rates and higher energy cost. And these are not in particular order, but these are larger sectors where in many cases the base is small. For example, manufacturing. I mean, there's a big opportunity because of it has a tailwind of China +1. It has a tailwind of whether it is Europe +1, China +1, and also a lot of reforms have been taken by the government, PLI, taxation, etc. So I think it's now or never for manufacturing in India, and that is manufacturing is about 17% of GDP. We missed the manufacturing bus a couple of decades back. But now the opportunities for real, as much as see India's share in global merchandise export is about 1.8-1.9%. It is lower than its share of GDP, and most estimates are saying that over the decade or so, our share would literally double. That the opportunity is also coming from the fact that China inherently is getting. There are issues why this China +1 is for real. One is basic cost competitiveness is waning because the labor cost has increased almost 2.5 times in a decade, and a lot of other issues have happened, whether it is how they handle what's happening on the political front, the opaqueness of the system, which is not giving a lot of comfort for a sourcing guy, that COVID is turn on off overnight, which impacts the sourcing, and also probably economic plus geopolitical plus emotional reason that you need to sort of diversify again about from China. So anywhere between $300-400 billion worth of opportunity it is, as I said, which is for grabs. But of course, that is one. Second is what is India's own strength in certain businesses and the PLI part. So the point is, this started about a couple of years back. COVID came in, there was delay in execution, but this would do well simply because the base is zilch. Let's say PLI, the base was 0 2 years back. We have seen some success in mobile manufacturing, etc. 14 sectors getting rolled out. but it can only move up. The extent can sort of vary. So that is why I was saying that manufacturing, it's not that our share of global export is very high that will be impacted. We'll be impacted by the near-term slowdown. I'm taking from a medium-term view, which is say about a 2-3 year view. It would, as things sort of settle, the PLI, etc., would help us regain the momentum in the manufacturing from a lower base. The second is on the housing side. Housing is again very large sector, almost 85, 90 businesses are dependent on housing. About 2.5-3 crore jobs, roughly, directly, indirectly, are linked to housing. Whether it is large businesses, whether it is cement, steel, building materials, etc. And housing, as many of you would have known, all of us experience it, had been a soft patch. In 2013, as a country, we sold 360,000 units. This year will be about 320,000. So after 10 years, there is a momentum. This is second year in running where we are seeing retail sales at 8-year high. It's a function of the affordability index being at all-time best. Affordability is a function of three things: what the income levels are. So in IT sector and all, income levels are decent. What the house prices are, in most cases it has time price corrected, and what the interest rates are. So of course the interest rate part is which has moved recently significantly. But even considering loans at around 8.25, 8.5 compared to less than 7-6 months back, affordability is still okay unless interest rates move and sustain about 9%. I think this would get derailed. Otherwise, the momentum may be few quarters here or there, but it would. Housing typically is a long, sort of longish cycle. So, as if the downturn was for about 8-9 years, the upturn also should be like 5 year plus. And some other things are also happening in housing in terms of consolidation of the developers, etc. I'll come to that. So again, here, if you look at it, the base is not very high. The base was in 2013. We are yet to cross that. And that time, the interest rates were also high. Autos is the third, again, very large sector. The simple story here is base is low. So if you say US interest rates are moving up, oil prices are fine. But if you see, if it's in Diwali, I think all showrooms were literally empty. Even the display cars, I'm told, have been the wait period of Maruti is 4 lakh units, etc. So basically, the base is low. In commercial vehicle, the sales are at 60-65% of previous peak. So commercial vehicle is up and down cyclical business, but the glide path is upward sloping. So the next peak is better than the previous peak, and the next trough is higher than the lower trough, the previous trough. That's the over longer term cycle because the function of GDP. But the base here is low. That's why it would do well over the next 2-3 years. The third part within auto is two-wheeler, again doing very badly. So the positive side is the base is again low. We used to sell 2 crore vehicles. Right now, the run rate is 1.4 crore. So since 2019, the prices have moved up for multiple reasons. And as we go further in the presentation, I think basically the story in auto is there is a pent-up demand, there is a need, and the base is low. So it will do well over the next 2-3 years. Rural, again, I think for multiple reasons, would stabilize, would sort of would stabilize because it's not been doing well. If you look at it, when the well-talked urban I think is not doing well primarily because it got hit by second wave. See, we have almost 3-4 years, fourth year of in fact consecutive reasonably okay monsoon. I mean, the distribution could have been better, but at least for the Rabi crop and all, there is enough and more rain 4 seasons back to back. So incomes would be reasonably okay, and prices have moved up courtesy the war, and MSPs have been increased. I think what impacted rural economy is the second wave was brutal, and rural is not necessarily agriculture only. There will be one guy who is working in city as a construction worker, etc. So that took a lot of time to come to speed and normalize. And that has happened over the last 6-12 months. So I think rural, because of better prices, farm income, costs don't increase because of urea, etc. is fixed. The monsoons are decent. Government support is there. After less than 500 days, we have mega event of election. So the support, I would assume, and the budget, which we'll talk after a couple of months, would obviously focus on that. And as I said, the base itself is sort of conducive. So I think it should stabilize in next year, 2023. Again, it is not so much impacted by US interest rates and oil prices. See, everything is impacted, but it's just the extent. It doesn't move the needle. Let's say monsoon is more important than the few points which again are important, that why we will be able to handle the headwinds, is the corporate sector profitability and the balance sheet is best in class. Is one of the best in last 15 years. Banking sectors NPAs have come down by 60% in last 3 years. Pre-COVID, they were cleaned up, and they had a painful period of cleanup, 2015 to 19 corporate loans. But it was so fit and fine that during COVID also we emerged literally unscathed, and we can see in the commentary and the numbers of the banking results which have come in. So I think not only banking, corporate India debt equity is low, forex loan is low, so you don't get impact as much. So the ability to handle currency, global volatility, the export is much higher because you don't have, debt is not high. So obviously that again should help weather these two headwinds. And then there are other factors which are important. There's a consolidation in the telecom sectors, so the profitability will only improve. There is a general consolidation. Sort of last theme I would say is that is general consolidation across businesses over the last 5 years for multiple reasons. It started with the experiment of the demonetization. A lot of things where I'm saying comparing unorganized or not fully compliant businesses with organized or fully compliant, strong businesses, strong management, strong balance sheet. If you compare these two, the unorganized part got severely impacted by demonetization, GST, tax compliance. Wave 1, wave 2 was more sort of all this COVID thing. Then the erraticity on the commodity prices. Who would have imagined that freight cost would move from $800 per container to $6,000 in a space of 6 months? I'm saying this year. So it's very difficult for a smaller enterprise to plan it. And then in these attrition issues and all those stuff. So multiple reasons, primarily being GST compliance related. We are seeing strong companies getting stronger and weak getting marginalized. Now, strong could be top 5,000, top 2,000, top 500, top 100 companies, better ones, better managed ones. Generally, obviously, the listed ones and the bigger ones. And the unorganized are getting, either they fall in line or most of them are sort of surrendering, literally, if you are to use the word. SMEs obviously exits. So this is what is happening is this trend doesn't get captured in GDP. For example, plywood is a 25,000 crore industry, and suppose there is a 10% degrowth. But 80% is Yamunanagar and all unorganized. 20% is organized. So that 80% would degrow more than 10% and 20 is growing. But the base is so small for organized that they may be growing, but the industry may be shrinking because of the trend what happened during COVID. And this is, as I said, it's happening across all sectors, even large franchise like in banking. If you look at now, the challenge is to get liabilities. So only the larger ones are able to attract it, likes of HDFC, ICICI, Access, 4-5 names. On the asset side, again, they are able to get, they're able to spend. ICICI Bank spent 3,000 crore in technology. Not any bank can spend so much. So it is consolidation for various reasons. Telecom, I touched upon. Most building material is because of tax compliance issue. So this consolidation is advantage earnings growth, and it doesn't get captured by this. And again, this trend has nothing to do with interest rates and commodity prices because it started earlier and it will continue for long. I think these 5-6 points are basically to give an idea that we were at cyclical trough pre-COVID, were to mean revert. If you recollect FY20, I mean, that time the GDP growth was less than 4.5% and it was 15-year low, etc. PAT to GDP was lower. You were about to recover. Then the COVID happened. So it got delayed and postponed, and sudden new reforms have come in like PLI, etc. So we would cyclically, the economy would cyclically uplift. This is very different from shock like 2007 when we were the other way around. It was market cap GDP or PAT to GDP and corporate profitability, leverage was there. You have the names of Unitex, etc. Those who remember that highly leveraged companies, and then you had the global shock. So it was the other way around. Here we are already at a low, maybe a few quarters, and we would only mean reverts. So our ability, and on a very strong balance sheet, ability to handle the twin headwinds is much better. That's the medium term summary. I mean, these are some of the slides. I've already covered it. So we'll just quickly run through about talking about the manufacturing side, why the housing would do well. The formalization thesis, we're seeing incremental market share over the last 4-5 years, advantage larger companies, and corporate health is one of the best. And there are a lot of reforms which have taken place even during the last few years. We are yet to see a period where we could see like good period of growth. Everything, something or the other kept on coming, starting from then banking issues. Then we had obviously the GST transition part and commodity part and COVID, everything. So the point is, life can't be always every time. You can't have once in a decade or once in a century event. So things would, as we see on the other side of the cycle, on definitely on both on absolute and relative basis, India growth will be much better compared to the rest of the sort of world. I'll come to market. I would like to sort of give on the third part of which is taking a more longer term picture, and then we'll come to the near term. I mean, on the market view is if you step back and if you look at it, while all these headwinds, which was mentioned earlier or so, even in last 6 months, there was quite positive news. I mean, you would have read news like Apple manufacturing iPhone 4, 2 weeks post the launch, 14, sorry, 2 weeks post they started manufacturing in China. And if a consumer tech, it is coming from that they started moving, and it's China currently has 90-95% of the share. So it's a long way to go on that. I mean, that's a very positive news, not from how much job it will create near term or so. It's just signal that it is that China plus one is moving, and India and India on its own has certain merits to become a competitive player in the global manufacturing. Another reason which I mentioned, I've missed while mentioning about why India should do well. See, India is among the few economies which will do well. So if you make in India, you make for India and also for the world. For a classic example is mobile set. I mean, all of us know the demand of iPhone sort of products in India. It's only growing. So you make for here instead of importing it and make it for the world, provided you're competitive. The point I'm saying is that a lot of trends are happening, and we saw that India being now the 5th largest economy. So the trend line is it's literally a no-brainer that the question can be debated, but the timing can be debated. But whether it is 2030 or so, will become the 3rd largest economy. The size will move from 3.5 to 5 trillion and beyond and beyond. There's a long runway to grow. And I would like to very quickly, it's important for investors to take that 10-15,000 feet view why India would grow. And it's also important to know that why other countries, I mean, unfortunately are not, so relatively will grow one of the best. There's literally a TINA factor here. The core pillars of growth of the country, and I not go in detail because I'm sure all of us know about it, is basically the demographics and the potential in infrastructure. That drives the demand. Demographics divides the demand because our median age is 28. Our demographics, the dependency ratio will improve all the way up to 2055. We have a 35-40 year window of favorable demographic in terms of higher working age cohorts compared to those dependent on. Many countries have seen the results in the past, so that period is started. It started start of this decade, last decade, and it will continue for long. Uh, Apart from that, a lot of other factors, the age cohorts in terms of the young generation, their ability to, but see, basically there's a potential to provide 1 crore jobs for next 10 years. Let's say if you look at a decade, and that's a very large number. The next country which has to provide, so it's cumulative 10 crore jobs required over a 10-year period. The next country, I think, is Brazil, about 1.6 crore jobs or so. So you will see large scale sort of, and the question is whether you want to provide the jobs, are able to provide the jobs. System is able to provide the jobs, quality jobs. But as people move from to the obviously the income generating sort of cohort, then obviously they spend more, save more, and that has a multiplier effect on the economy. The other point related to demographics is on the urbanization. About in 15 years, about 1.5% happen, 0.2, 0.3% or 0.15. And the trend line is there. We are almost 15 percentage point lower than China. So urbanization has an impact on the demographics. And obviously the per capita income increasing. When you look at when you'll become a $5 trillion economy, let's say by 2000, 5 trillion will be about 2027. But as we double the size of the economy or so, obviously the per capita will move up from 2,300 or 2,500, less than 2,500. Because of currency, it could be probably 2,400 to more than 4,300 per capita. And historically, it has been seen that this 2,500 is an inflection point, because when it crosses this level, you tend to spend on different categories rather than basic necessity stuff. You spend more on other items, more discretionary items. Then, of course, we have the advent of gig economy. Hopefully, that plus PLI would help provide some of the jobs. There's a report by BCG which called for 9 crore jobs over a decade because of the gig economy. Of course, these are not necessarily all new jobs. Large part of it is migration, but because of shared economy and the gig economy, I think that also is a big event which will happen. The second piece is the infrastructure side. I mean, the potential is huge. All of you are from NCR and all. In Mumbai, I think I never seen the development, which is the shape of the infrastructure of Mumbai would change in the next 4 or 5 years significantly. I mean, there's 13 tunnels going on metro. There is a Trans-Harbour link. There is a new airport coming, and this is the potential in the financial center of the country. So I think the point is that the country is starved on infrastructure, and we need to invest in infrastructure which literally doubles in 8-9 years. Good state, good government, good governance, good policies, it accelerates it. But that is the large size, and NIP has called an amount of 110 lakh crore over 5-year period. And then, of course, all that is lubricated by huge reforms which have taken place. I talked about some of the large scheme. In addition to that, there are a lot of softer reforms in terms of digitization. UPI is a case study. What it has sort of done, our JAM architecture, we have seen how seamlessly the vaccination part was done using Aadhaar, etc. and all. So net, the ease of doing business would improve. So these are the drivers why we should grow at 5.5-6%. Potential is higher. I'm saying base case growth of north of 6% should be there, which clearly stacks up the best, because as many of you would know, China's, I think, the best period of growth is behind. Over the next, I think IMF a couple of weeks back did a projection for calendar 27 to 22. India was north of 6%, 6.4 or something. China was 4.6%. So the point is, and then of course, I mean, and we are talking of large size, large, varied, and of course the other softer aspects of the thing. So the point, the sum and substance is, I think there is a cyclical recovery which would happen, which I talked about it, because we are at closer to trough. So it would earnings would rebound over the next sort of 3 years. Sorry, my apologies. I need to cover the market part and then come to this conclude. So what does this mean on the equity markets? I understand most of you are investors in equities. So your earnings growth, if I index to pre-COVID, which is FY20, and post-COVID, which is not current year, because current year was again very erratic because of war, because of everything, which is unprecedented. Asian Paints said that they've never seen inflation last 40 years. It is all normalizing, but that is impacts on the profitability, except for banking sector. So let's take FY24, which is what we would talk after a couple of months. So on a 4-year window, we are seeing about 16% sort of growth in sort of earnings. If you look at P multiples, we are around 18 times. I think it's closer to the longer term average. So markets, while being resilient and has not corrected Indian market, that means our valuations, relative valuations, have moved up. So I don't think they are very cheap, but I would also not be in the camp that they are very expensive, or it is because it's a function of where the economy is headed. We have seen previous cycle over last 2.5 decades that while interest rates moving up not necessarily impacts the earning, it is more important is where you are on the cycle. So we think there is a sort of cyclical upturn which will happen structurally. I also touched upon longer term is beautiful. By the way, if you look at last 30 years returns, CAGR globally, 30-year, 20-year, 10-year return, India has been in top 2 local currency sort of returns globally. And these were the period last 10 years have been as erratic as it could have been. So I think is literally, I mean, one should not say with too much of confidence, because things can always be very volatile, but there's literally limited alternatives, definitely on relative basis, and on absolute basis also we are fit and fine. That would get capital. So when people say FIs have exited this year, yes, they have exited about 17, 18 billion. It's more to do with US interest rates. It's more to do with other markets not doing well. India is a part of regional market. I'm just talking about flows, FI flows. So one, it is being very nicely balanced by domestic investors, but the FI money, to my mind, on a longer term basis would come back because of the growth. And we have enough shock absorber to navigate the current chaos. And I mentioned, if I had to call out the trend, demographics and infrastructure is known. What is not known is manufacturing. It is subject to execution, but if it were to actually double, it will be a very big achievement, because an economy cannot survive on services. It has to have that manufacturing piece coming, and these are correlated. Inclusion in the global bond indices, to my mind, is a game changer. It's getting delayed because of some taxation issues and all. I don't know the exact thing, but hopefully 2023 it happens. So what will it do is, why it is game changer, not only for fixed income, it helps in current scenario when currency is under pressure to get a new source of money. Our base back book of foreign invested in fixed income is very less than $40 billion. We don't have much to worry. So when you get in the indices, you'll get initially you'll get a higher number, $20-25 billion, then a steady flow of another $15-20 billion. That helps in financing, that helps in currency, that helps in balance of payment. The only worry or the major sort of concern to my mind remains energy and oil, because it's to be seen along with the currency. With the currency depreciating by 9%, if oil is 90, it's equivalent to more like $100. Anything above 120, we gets in a very, very definite sensitive zone. And I'm touched upon it impacts risk, it impacts multiple factors, and literally, that's one which can derail or make it erratic. I mean, it's not a. No one is saying, I think, for long oil will remain very high because of the advent of EVs, and that would put a cap. But it's purely, I mean, those of you who are reading it's, let's say, recent, is purely geopolitics. It's not geopolitics, it's purely politics. In the sense, like one of the guys saying that it's a cartel, blatant cartel. They want to constrain the supply, despite oil being high. So I think net sort of these are the key things that why our economy would do well. From a market perspective, my view is that it's reasonably priced. If you're investing now, which I mean, one should invest from a very longer term lens, but from a medium term lens, I think there are 2-3 things I would like to say. One is, should have a time frame of 3 to 5 years. In equity, you should always have, but more so now. Second is to have an expectation of low teen sort of returns. And third is not to make a lump sum thing, more invest in a systematic manner, because things are volatile. We have seen June, something happened where markets corrected and also just capitalize. And nonetheless, it's not very cheap. So if this be the case, that your expectation is 12, 14, 15% and time frame is 3 to 5 years, I don't think NAV returns would disappoint. And longer term story is absolutely sort of solid, but one should not, while the challenges are there, but the headwinds are there. Clearly, I think it's taken 45 minutes. Probably the tailwinds are much more dominating despite game-changing sort of headwinds. So with that, I would sort of pause here and pass it on back to Rajul. Thanks.
Thanks, Nilesh. I think that was a big relief to know that tailwinds are stronger than headwinds, because, you know, when you look at the headlines, they mostly talk about the negatives than the positives. And that is what everybody, you know, kind of wakes up to every morning. So there is a question on currency that INR has depreciated against US dollar, far lower compared to other currencies. And it has actually appreciated against euro and Japanese yen. So do you think that makes us less competitive and puts pressure on our exports and results in worsening of our trade deficit? Because that is one area of concern, I would think.
Yeah, absolutely. So RBI worry and interest rate today is a more function of currency, balance of payment, etc. Rather than inflation. I mean, both are, I mean, that has taken a precedent because, as you would have read, I mean, RBI has put in almost $100 billion. $65 billion is a drawdown from the reserves, and forwards have been reduced. So they have put in to protect the currency. By the way, currency movement is, one is dollar is strengthening. So it's not that India is alone. India is unique in the sense that the current account part is weak at 3.5, more like closer to 3.7, 3.8%. So we actually didn't depreciate for quite some time because RBI was defending. And then we had this recent bout or so. So it had to course correct to be competitive in real effective exchange rate. I think it's, I mean, very difficult to call out. There are 2-3 points near term I've talked about. What is the strength of US dollar? Second is also on the balance of payment. And if you look at it in general, the depreciation template is that whatever is the inflation differential, the currency should depreciate so that the countries remain competitive. Now that has gone topsy-turvy. Today, inflation in India is lower than that in US, right? So there is logically, if on this template,
ideally we should be appreciating, yeah.
But that is too short term to sort of, and this has happened in too short period of time. It will mean revert. They will come down and will remain at these levels. But the point is, I think longer term, it will still be 3-4%. Current should be seen more in context of balance of payment sort of situation. So I don't see, I would be in the band of, let's say 1 year down the line, maybe closer to 85, 83, 85 band. We are already 80. But can it depreciate significantly? No, unless oil goes to, again, I come back to oil. Oil goes to 130, 140. Can it? I mean, yeah, that's it. It would remain at sort of. It has to your question. That does it make it? I think at the end of the day, if you look at it, even PLI, see, no support, no currency can help sustain an export business. Where we have done well, where we have a right to win. We are doing well in IT services at about $180 billion of exports, which could still double over a 6-7 year window because no other country can compete with us. We are doing well in certain smaller sectors, chemicals, specialty, so we'll do well there. So currency is one point, even PLI support to my mind is one point. I think there has to be right to win of the business to become competitive, stand on the feet and do it. Europe, by the way, has other problems. So to that extent, this Europe plus one is also relevant. Yeah. So I don't know. I probably diverted and question. I don't know whether properly.
No. So one part is that on PLI, since you touched upon it, telecom, we've seen a huge success. Are there any 2-3 other sectors where you see them becoming equally big? I mean, where we have a natural advantage, like, which is
So we have, absolutely. We have natural advantage in engineering. We have natural advantage. When I say engineering, let's say defense. So defense, a lot of things have happened in last 5-7 years. It takes a lot of time for government is encouraging different exports. Why can't large companies from India come and make exports for world? We have the forging skill, we have the casting skill, we have the engineering skills. We have the software skills, the hardware skills for that. So the base is low, but you can sort of do well and government push is there. So there is a right to win. We can win over the next decade. Definitely, I think defense first thing is we'll reduce imports, which is already happening. Yes. And government is supportive. Then we can increase exports. Second is IT I talked about. Pharmaceutical has always been there. Anything to do with specialty chemicals, R&D part, or there is a right to win in terms of CDMO opportunities, custom synthesis, custom manufacturing, chemical sectors. We have seen some of you must be equity investors, what chemical stocks have done last 5-7 years. So it's a long way to go over there. Even some of the basic industries, for example, steel and aluminum, nowhere in world you have in case of steel, iron ore and coal available within a radius of 500 kilometers. In case of aluminum, coal and bauxite within a radius of 500 kilometers. We are mineral rich in Orissa and all. Unfortunately, a lot of problems. You remember the scam and this and that. A lot of things. It took time for that trust to sort of happen. And for all you know, government has put an export duty to curtail the inflation. But longer term, if there is a right to win, there is a right. Why our steel exports could not? If China is at 15 times our level, we can be equally competitive. Lastly, is a lot of labor-intensive sort of industries where, again, it's head-to-head competition from China. So I think there are sectors. PLI is just a push. It's pragmatic scheme. It's not that it succeeded in mobile. Some people say it's not moving in the other pieces and all. Government is listening. They are tweaking in. It's very pragmatic. So not sort of
very agile this time.
Success breeds success. Yeah.
Right. So on currency, on technical factors, you said that next year, if we get included in global indices for fixed income, and if we get the FI flows again back into the country, which reverses, last fall of last year, we have actually they've taken out something like, I think, 2.5 lakh crores. And thirdly, if the weight of India in MSCI Emerging Market Index has also gone up and is likely to go further if Korea moves to the developed markets index. So if these three things happen on the technical side, do you think rupee could actually appreciate?
No, I think the most important, the most important for currency is the oil, because the current account is what is causing the pain. Right. I think 4% current account is a danger number. We are closer to that. You have to be less than 2%. There's a long way to go. So while all the points which I mentioned, they are important, but they are like
mainly oil to watch out
global indices. Money coming cannot change the fundamentals. It can help fill the requirement of trade balance. But the fundamental is oil. And if oil were to go above 120 and remain there, the currency can, in my mind, appreciate more than 85. But if it is less than, first of all, all these factors have very limited bearing on our equity investing. Also, these macro calls don't decide on that. So they're limited sort of thing. But I would say that if oil were to remain range bound, which is a base case scenario, then it's not that we will cross significant depreciation from here on.
Nilesh, right now we are undergoing the earnings season. So what are the key takeaways from the management calls you might have attended for the last couple of weeks?
Yeah, sure. So one is the one clear sector which we have been calling out will do well is banking. We touched on that. So that's superbly doing well. And Mr. Kotak mentioned it's a Cinderella moment because you have a loan going up, margins going up because generally the interest liabilities take time to get priced. So they are seeing super duper sort of results from all banks which have come in except from one large bank. So, and that is moving the needle in terms of earnings growth and for the next year. So that is fit and fine. Beyond that, it's been mixed and erratic. And I would say that I would give it a pass FY23 for one is, let's say this quarter and all, we had that lag effect of huge spike in the commodities, freight. I mean, I never heard that pharma company getting impacted by air freight and sea freight rates. The margins getting impacted by that. So all that would sort of normalize. Second is we would have according to me, a bit of soft patch because we are not immune to global economy. It is indeed slowing down, and that will have a couple of sectors, IT and metals to be precise. So on the current quarter also trend wise, there are pockets of strength, banking. There are pockets of strength in the sense that they would do well, but the current quarter is not good on margins. But consumer discretionary, autos, we'll see they will do well, although the current quarter is not fully reflecting, but they are in that positive zone. Then there are names where IT, which may be doing well, but it is wait and watch, and metals, of course, is not so good. So, and of course, oil and gas is not good because of government policies and all. Then there are smaller sectors like capital goods, defense and all, which is doing sort of well. Pharma is very stock specific, but is in general is doing reasonably okay.
So do you see any downgrades? Because in your chart, you were showing that from 20 to 24, earnings growth, I think I'm assuming it is for Nifty companies, was about 24%.
Yeah, but base was also low. So the point is, let's say the absolute number of earning is about 7,60,000 crores for FY24, which is 960 rupees EPS for Nifty. I don't think it's already come down by about 4%. So this YTD downgrade is 4%. It's not very high compared to other countries. And I don't see much risk to FY24 earnings because incremental earnings almost 40% is coming from banks, which is sort of in the pocket. Unless
which is solid, you don't see any risk.
And other places, I think it's be okay. There are some positives, negatives which will outweigh. But from these levels, I don't see much risk to the earnings. By the way, there is a possibility that a year down the line, most of these macro noises, my gut feel, I'm using the word gut feel, is that inflation, obsession with US inflation of market participants and all would be in the base. So when the dust settle, I think, as I mentioned, we'll have that uptick both cyclically and structurally. And that's when we will see the actual acceleration in earnings towards second half of FY24. And that's when people will start building in FY25. So some part which is lost in FY24 because of this global thing, it's more, we can't give a P multiple to that. It's more pull down momentum. Let's metals and IT.
And what about rural demand? Do you see that pulling down India's GDP in the short term?
No, so it's not doing well. So rural is not doing well. So I am looking at it, as I said, more glass rather than
created a low base, it can only improve, you're saying.
See, you are saying the indicator of rural discretionary demand is two-wheeler, but of course two-wheeler, the cost increase also happened, so that may not be the best, but otherwise also we are seeing from the results Titan is doing very well, but even rural centric companies are not doing, FMCG companies are not doing very well. So I think as I mentioned, base, better farm income, government support, and construction jobs and all coming back, all put together would help 23 to be better than 22.
Nilesh, there is a question on US technology stocks. I mean, there's been a huge correction mayhem actually in the last few days after they've announced the results, Meta and Amazon and all of them. In fact, Meta corrected by 25% in a single day. You don't expect that kind of a correction from such a large company, especially in the US. So what is your take on this? Do we see more prolonged correction? And we also have some client exposure to the Mere Fang fund.
Yeah, no, absolutely right. So that is an ETF in the sense like, see, this correction is primarily driven by interest rates and of course softness in the near-term earnings. So if the question is on S&P 50 or Fang or the large consumer tech companies, I think post the correction, obviously they've become quite interesting in terms of the free cash flow yield, and we'll see some of them doing buybacks, etc. But yeah, it's a complex subject because, as I said, in US, the macros, how much they could worsen further before stabilizing is actually it's a complex subject. Even I mean, when even Fed has got it wrong so many times, who are we to sort of prejudge? Because my limited understanding is that the invitation to slow down or recession has to be so significant that your labor market collapses in terms of the stickiness of labor inflation, which is a lagging indicator. So it's not that you increase the interest rates and tomorrow it would happen. It will take some time. So all these companies are also part of what's happening. The results, Meta and all, is primarily driven by the recent earnings sort of thing. So each would be a different sort of space. But I would just say that with the correction and P multiples now in the range of 16, 18 times for these consumer strong franchise or top 150 companies, it's pretty interesting only to seasoned investors who would like to diversify. Otherwise, for most investors, India remains the best.
Great. So just to sum up, Nilesh, what kind of GDP growth rate can we look for India with a 3 to 5 year point of view? And similarly, what kind of earnings growth and what kind of stock market returns? Because each one is derived from the other. Yeah, so the GDP growth should be 6 to 6.5% real, say at 5% of inflation, so 11.5% nominal GDP growth, which means you are doubling in 6.5, 7 years. Our economy is doubling in 7 years. So if about 11-12% of nominal growth, corporate earnings, as I said, corporate sector consolidation could do 13-14%. You pick right set of companies, about 14-15%. Keep some margin of sort of error. So have an expectation of 12-13%. Ideally, around 14-15% is doable over 3-5 years period in terms of equity returns. Right. Oh, that sounds great. Nilesh, so that brings us to the end of our session today. Thank you so much for your time. And those were great insights. I'm sure everybody is feeling a lot more relieved, especially it's the festive season. So it's good news. And thanks everyone for your time on a Saturday morning. If you could please fill in the feedback form as you exit the webinar. Thank you, Nilesh. Any last words? Thanks for inviting, and thank you. Have a good weekend. Thank you. Have a great weekend, everyone. Bye-bye.